Good afternoon, everyone. Evening for some and morning for others all around the world. Welcome to today's April 16th live trade call for the emergency 911 trades. And we will get started. I just want to make sure that that everyone can hear me and see my screen. Okay, just type something in the questions box. All right, perfect, excellent. All right, we will go ahead and begin. All right, so today, going to cover a couple of things. Just going to do a quick rundown of the current trades because we did enter into a bit of a different situation with the volatility dropping. We entered into these trades last week. And so, unlike when we first started, when the volatility was super high, we could place on a trade a couple of days away and we get out of two or three possibly in a week. Now the opportunities are not such that we can do that because volatility has dropped, stocks have come back up. And so we're having to do things a little bit different, but that's why I have these live calls to show you how to adapt to the changing volatility. That is what creates these trades. Either the increased volatility in some approaches, the lack of volatility in other approaches, and then other approaches you can do when the volatility is kind of in the middle, so to speak, which is what we see right now is a mid-level volatility in these options, and it continues to decrease because we continue to stagnate. And so these are becoming a little bit harder to find, but there are things that we can do, and we have been trying to do them, showing you how to mitigate risk, push risk further to the upside, etc. And so the first trade we're in was the 274, 276, 277 strike call spread from a credit of 140. And that one, as of right before we started the call, was trading at about a debit of 10. Which means that we are sitting on about $150 profit on this trade. And I'm going to tell you right now, I do not like where we're sitting because we are it's about 278. Market's trading around 278, and we're 2 or 3 points away from breaking even, or maybe even taking a small loss on this trade. So if there's I hate being hostage to a trade based on a one-day movement, but it is what it is. We're sitting on about $150 profit on the trade. The profit potential, if the market moves down a little bit tomorrow, is not going to be 500 bucks, which is with the volatility as of last week when we got this in. It's going to drop down to maybe 350-ish, maybe 400, based on what I'm seeing going on with these options. Nonetheless, that break-even level will also decrease. It will not be at 283. It will be closer to 281 ish. So we'll see how it works out. I also am going to make a suggestion, and it's not the best scenario in the world, but it depends on what you want. So we have a credit of $140, and the market will absolutely have to tank for us to only make the $140. So if it moves down, we should be looking pretty good, all the way into the 265, 267 area. So if the market crashes 10 points tomorrow, 12 points tomorrow, we're still going to make more than the minimum credit of $140. Okay. However, if the market moves up 10 points at this junction, I don't think it's going to move up 10 points. I don't think there's anything supporting the market that well. I mean, obviously you've got the trend, you've got the general move towards opening the economies, worldwide. Even though it hasn't happened yet, they're talking about it, and that's energizing a little bit into the market. But that's where the trend is going. And so, if we move up 5, 6, 7 points from here tomorrow, you're going to be looking at taking a decent loss, we're going to see this trade go from $150 profit to $150 loss pretty quick. So the question is, what can you do? Because if you didn't take the opportunity to get in, you had a spread. It was an 82-84 spread at $1. The official signal was not filled, and even though I was filled prior to that, and there were several opportunities to get in prior to that, on Monday, unfortunately the official signal didn't get filled, and so that one would have been really, really good at this juncture. So what can you do now? Because you can't get that for $1. You can't get it. It hasn't come close. It got down to maybe $1.15 yesterday at one point, and that's about as close as it got. You could have paid as much as a $1.40 for it, and you would have no credit. So a couple of things that you can do. You can take a small debit on that trade and risk the market crashing, and you lose $20. Or you could buy the long leg of that trade, and you'll pay a little bit more. At least right before the call, you'd pay a little bit more than $1.40. I think you would have paid like $1.56 or $1.58, somewhere around there. And then if the market moved up, you could add the short at that point, or you could take a profit of $100 and offset the risk, or whatever the case is. Right. The risk on that is, and it would be an April 20th call. So we'll look at that here in a second. But I want to throw that out there, because if the market does move higher, we will be looking at a loss on these trades, because they are moving the volatility out as we speak. And if it moves up tomorrow, it will come out even further. So it is what it is. The second trade was a 274, 278. So the short strike was, or one of the short strikes was above the long strike. So it was 274, 278, 277. We got in at that for a credit of 5 cents. And right before the call, this was the better trade, to be quite frank. But I wanted to create a bigger credit. So I officially took the other one. I took all of these, but I officially took the other one in the signals. This one was for a credit of 5, so there is no room to add to this trade with a debit spread, because we have a credit of 5, and that's it. So if the market tanks, I make $5, and that's it. But if I put a debit spread on here to address the risk, then if the market tanks, I'm going to end up losing money, and so I didn't want to do that. And so with this trade, though, it's sitting on about a $200 profit right before, and it's in better shape because the break even is way further to the upside, because we have one of those shorts that are at 278 instead of 276. That's a $2 difference in strike, pushing that risk further to the upside by more than $2. And the risk is also smaller on this particular trade. So this one's sitting at about $200 profit right now, and that's looking pretty good. The trade 3 was also a credit of 5 cents, and the reason I discussed this one is that we were comparing it to the trade 2, and you can see here the difference between the two is not that much different with regard to the max profit potential. Okay, so that's trade 2. Trade 3, it's also a credit of 5, so that's the same thing on the downside. The risk is, the break even is at about pegged at 282.50, and the profit potential is obviously just over 400 on this one. And so if I were to look at the two different trades between what creates the credit of 5 and what happens with the risk and where it happens and the break even, trade 2 is clearly a better trade than trade 3 in all aspects. So that's how you go about measuring which trade is better. Take a look at what you're getting for a credit, what's the risk, and then what's the maximum profit potential, and that's going to give you a really good, solid idea. And then there was another trade that had a bigger credit than trade 2, And this trade is from a credit of 75. You have almost the same risk. It's about the same risk as trade two. And the break even level is up around 285 again. Again, that's probably going to be a little bit lower than that, but this is a solid trade. And again, the max profit potential is about 500. So now I have trade four and then compare it to trade two. Okay. There's a bigger credit. It's a credit of 75 cents, where trade two is only 5-cent credit. Trade two, the break even is actually a little bit above 285, whereas trade four, it's right at 285. So that's a slight difference. But the risk on both of these is about the same. Trade four is slightly bigger risk than on trade two. Okay, so for me, trade four would be better than trade two. From the standpoint that I can at least bring in a little bit of credit. And if I wanted to, I could probably address a little bit of this risk at the 285 level and not get rid of my credit, because I can go further to the upside to address the risk, as opposed to the first trade that we're in, which created the $1.40 credit. And again, the reason for the $1.40 for the trade one, I was willing to take a little bit more risk in order to create a bigger credit. And then obviously they give you the opportunity to get into that. So here's one of the trades that was available. Obviously is not. In order to address risk to the upside, you can move this up the scale if you want. But I said, well, we can get into this from a debit of 140, which I did last week. That it has not hit a debit of 140 since last week. So it was only available for a little bit of time, and I was able to create this risk-free trade last week. If you placed it on, after last week, or you didn't add anything to the trade or whatever, then, we have the credit of $1.40, and that's that. But again, that's why I urge everybody to learn how to do this on their own, so that you can enhance your own trades. Then I talked about a 424 core trade on Tuesday, and I was filled at $1.52. And many of you were actually filled on this trade. You during the call, you let me know that you were filled on the trade during the call, and added. You could have added a trade immediately, because we were so far out, 424, as opposed to 417. So we're more than a week out. So that sometimes offers a little bit better opportunity to add a trade, something simple like this. 289, 287. Again, the short is above the long. That creates the debit, and that creates the profit potential to the upside. Or you could have done something like the 282, 287, 282 for $1.40. Okay. Either way, adding those two together at the same time created this combination. And again, many of you were filled on both of those trades for a credit of, I think somebody was filled at a credit of 15, somebody else was filled at a credit of 25. If you would have waited on this trade, instead of buying at a $1.23 debit, you could have waited for another 20 cents. It actually traded as low as 90, I think, yesterday. And you could have waited for $1 and got a bigger credit of 50 cents on the trade, and that would have reduced the risk even further, pushed everything up even further. But the break even on this one is all the way up at around 293. It's going to be much less than that, probably 291-ish, maybe 291.50-ish, because if the market moves up there by next week, they're going to continue to tank the volatility out of these options. And so you have to plan for that. But nonetheless, it does give you a much wider profit range to account for and compensate for the extra time that the market has to move up into that zone, which it absolutely can do. Don't know whether it will, but it absolutely can. So wanted to take a look at that real quick. And there's if you want to look at how those trades, they're synergistic trades is what they are, and how they correlate with one another. So you can see how that risk graph is created. Of course, you can do that on PDS Trader. Okay. Then there is one additional core trade that I mentioned, and again, I was filled on this one. And this particular core trade, the break-even level is all the way up to 290 without doing anything else to the trade. So I really liked this one. And it's a 279, 283, 282, 283. So it's a 1111 from a credit of 1. And that unfortunately is not available right now. If the market does move up, it will become available again. It's trading at a credit of about 50 right now because the market is down from where it was on Tuesday when we were talking about this trade. And then I did release a report that goes into these as well. So hopefully you had a chance to review that report and just continue to get a solid feel for what's out there and what you can do with these opportunities when they are available. Okay, so what we're going to do is we're going to take a look at where these trades are at. I'm going to again mention the 140, the credit of 140 signal that we are in. So hang on for me 1 second while I get to that page. Is this it? Yep, this is it. All right, so the market's come down a bit. Let me make sure y'all can see my screen. There we go. All right, so the market has come down a bit. And order one, let me see if I can make this bigger for you guys there. So we're trading at a debit of 30 now. So that means that we have a profit of about $170 on this trade. That is our current profit. Oh, look at that. Nope, that's not it. So you can actually buy a 282 is trading at $2. So you don't want to do that. That unnecessarily creates a debit. 282. So let's see here. The 284 is $1.43. You could theoretically, you could buy the 284, and if the market goes nowhere, it's going to eat into your profits pretty significantly tomorrow. So if the market does move up, it'll give you a chance to either take a small profit on the 284 and offset some of the loss, or sell a call against it. So you can then, instead of doing so you could sell the 284 for $1.40, or excuse me, buy the 284 for $1.40, and then sell the 283 for $2. You know, if the market moves up, it probably won't to that degree tomorrow, but it could, based on the current trend. So that gives you an idea. So that's trade number one. The top trade is trade number one, the 274, 276, 277 trade that we are in. And again, about $170 right now on that trade. The extrinsic value that's on the 274 call, we're trading at 277, so 373. So there's still about $1 of extrinsic value on the 274 call, and then there is well over $2 of extrinsic value still on the 276 call. So it still looks good. I'm just concerned that because it's not going to take much of a move for this thing to give back the entire profit and then some. So yeah, I do fret over these things just like everyone else. I hate losing. So, you know, even though I'm accepting the risk of that trade, we're so close, and there's really nothing that you can do that is tremendous, except for potentially setting yourself up for the next week by creating a debit trade the next week, and then if the market moves up tomorrow, you can make that trade a risk-free trade. So a 420, you start with a 424, 427 debit trade, and you know, if the market tanks, you know, if you, let's say it's a $1.40 debit trade, if the market tanks tomorrow, you could lose that $140 on next week's trade, but you have the credit on this week's trade. But if the market moves up tomorrow, you'll be able to make that trade risk-free. So, you know, all sorts of things you can do. Takes a little more planning, but again, sometimes you you can try and you can just do too much, and so you just have to accept the risk. And then if there's something that's good that you're able to do to mitigate that risk, great, do it. If not, then it is what it is. All right, so trade number 2 was the 274, 278, 277, and we got in that at a credit of 5 cents, and that's trading at a debit of 140. So that's order number 2 here. And let me go back to that so that you can, let's see here, 274, 278, 277. So that's that trade. And we got in a credit of 5, and as of right now, it's trading at a debit of between about 135 and 140. So about almost $150 profit, $145 profit in that trade open right now. Then order 3 was the 274, 276, 276. Again, that was a credit of 5. It's also trading at about 140, it's trading at 140 debit, so that's about $145 profit. My favorite on the bunch because of the 75-cent credit on this trade and the higher break even. That's trade 4. And right now that in order 4 is trading at a $78 debit, so that's at $150 profit. So all of these are about the same profit right now, and I mentioned that they are very similar from that standpoint, with regard to the neutral area, the profit zone in the neutral area, and they're all showing to be about the same in open position profit right now. So the 282, 287, 282 spread, order number 5 is this one that I was able to get into last week at a debit of 140, and right now it is at a debit of 309. So that is a $160, $170 profit on that trade, on top of the $170 profit on the 140 credit trade. So combined, those two are doing really well right now. And again, that I was able to get in at a debit of 140, so that created a risk-free scenario. So no matter what, I was going to be able to profit on that combination. So that one's good. And then here are the 424, 427s that we talked about on Tuesday. The first one, 279, 281, 282. We got in at a $1.52 credit. Okay, so order 6, $1.52 credit. It's now trading at a 95-cent credit, so we're making about $50 on that one. And so that one is this one. And the market is not trading at 283. We're trading at 278, which is basically just below the max peak profit on this one, but this one doesn't expire until next week, so we got to hold on to it. But we got in at a credit of 152. Market has come down off of the levels, and so it's trading at now a credit of 95. Again, that's order number 6, if you can see that. And then order number 7 is a combination trade that is very similar to what we were talking about. So if we take this core trade and then we add this trade, which many of you were filled on both of these trades on Tuesday. At the time, it was trading at a debit 23. Now it's trading at a debit of 103, which is order number 7. So you can add these together, and it's not the combination is not trading at a credit of 20 cents anymore, or 25 cents anymore. It's trading total at a debit of about 10 cents, which means there's total profit on the trade of about $30 is what we see open position right now. Okay, and then finally the 4-lot spread that we took on the additional core trade that we mentioned from a credit of $1. This is a 279, 283. So there's 4-point strike difference between the two shorts, and then a 282, 283 long. And so that means it's a $3 strike difference between the 279 and 282. Zero strike difference between 283, 283 plus a credit gives me a total risk on this trade of $200. And right now it is trading at a credit of 50. So again, that one also is making about $50 on the trade. Of course, on this one, you can easily add something to offset the risk with this because of how far the market or how far up the break-even level is. So you can actually go, 287, 280, 292, 287 call spreads, something similar to this, only all the way up to around 287. So a 287, 292, or not that one, sorry. So instead of a short 282, 287, you can go a short 287, 292, and then a long 287. Again, April 24th, 27th spread, and that would easily offset the risk on this one as long as you got it for a credit of less than $1, or you could switch it up and bring the strikes in a little bit closer if it's too expensive to make it less expensive. Those are what's available, and there's not much difference. I think there was one more that I wanted to look at, so hang on one second while I take a look at that. So right now there is a trade that I just opened up, the 911 emergency 1111, and I looked at 424. And this is one that came up that was at a 21-cent debit, so it's not tremendous, but it is nonetheless one that has a decent profit potential, a nice profit range, and a decent risk, a pretty small risk. And the break-even level is projected to be around 285, and of course it's not going to be correct. It's going to be less than that. But that's one that is available now. And I don't know if you can see that screen, what the levels are, let's see there. How's that? And there you go. This one is a 275, 277 longs. And then the shorts are 270, 250, 270, 750. So the shorts are actually 5 points difference between the two shorts, and then one of the shorts is a half a point above one of the longs. And so on this one, it lists it's a buy sell is how it lists it. So it's not the way I put it in the PowerPoint, but you can do the math. It's 2.5 points difference on one. It's negative 1/2 point difference on the other. That's a total of 2-point difference in the strikes minus the credit. So you have a total risk of $179 on this trade max, no matter what happens. If the market skyrockets, you can't lose more than $179 on this trade. And you have a very high probability of being able to do something with this trade at some point to address some of that risk. Although the credit is 21 cents, it's not going to give you a lot of room to create a debit trade, but they aren't completely impossible, especially if you go to the upside. This one is not as good as the one that I just showed you, the 1111 that I just showed you that we placed on Tuesday, but you can't get that one for $1 credit. You have to pay 50 cents credit, which means that your risk is actually 250 instead of 200 on that one. So don't necessarily want to do that. All right. So what I'm going to do is I'm just going to take some questions on the trades before I get to the next section, which What I'm going to do for the next several minutes is I'm going to show you all the Trade Finder, and I'm going to be discussing the Trade Finder so you can maybe tweak some of your own. I'm going to be talking about some frustrations that you might come across with that as you're doing it, and how to quickly just kind of make some slight alterations and create your own Trade Finder, basically. So let's see here. Questions before I move to the next section on the current trades. And the market is coming up as we speak, giving back. So that's now at a 13-cent debit. Nonetheless, all right, let me take a look at some questions here. All right, so tomorrow, if we're trading around the same level, 277, 278, 279, somewhere around there, what's going to happen is all of these are going to have value in them. And so all you do is you just exit the trade. Okay, the entire trade. This is trading at a credit of 14 now. This is for the entry. If I were to inverse this, all right, so I'm going to inverse this, but I can only have 8 orders on here. So I'm going to do this. And this is trading at a credit of now 13 as opposed to a debit of 430, which is what it was 10 minutes ago. That's how fast, as the market moves up, this is going to be, if it continues moving up, it's going to give away, more of our gains. But nonetheless, if I do an inverse, so duplicate inverse, now I have my exits: buy to close, sell to close. Only it's at a debit of 19, or debit of 12 now, which on the reverse would be a credit of 12, right? But we're exiting, so it switches it all around, okay? So what you want is you want to get out of this as low of a price as possible. So I might, if we're trading at 19 tomorrow, I may put in an order to get out at 10, and I'll leave it for a few minutes, and then I may get out at 12, and then I'll leave it for a few minutes, and then I may get out at 14 or 15 until I get filled. And it's the whole spread. If we're trading where everything's in the money, it's the whole spread. And that's how I would go about doing that. It's more difficult to exit this trade on a leg by leg basis, especially if one of these so like if we're trading at 274, the 276 call is going to be out of the money by 2 points, and it's going to maintain value up until the last 10 minutes. Even in the last 10 minutes, you might see it trade for 10 cents or 5 cents, even with it being out of the money by 2 points. Now you can exit one of the legs and then just get out of the spread with 274, two of the 277s. But even then, you're probably better off just getting out of the entire spread. Ideally, you would let the short option expire worthless, but if you hold on to that short, they're not going to. In a lot of cases, if you have a certain kind of account, if you don't have a big enough account, et cetera, et cetera, et cetera, if you try and get rid of one of these, or if you try and get rid of both longs and hold on to the 276 short and just let it expire because we're trading, let's say, at 274, there's going to be a problem because they're not going to let you hold that naked short call a lot of times. So unfortunately, you do have to get out of the same trade, and it's the best way is to just get out the same way you got in, the whole order, one shot, and not make it difficult. But you want to pay attention to the extrinsic value of these shorts. You do not. So, for example, I think it was last week, we were trading, again, right in the middle of the profit zone, and you had to wait until the absolute very last second to get out because the shorts, the at the money short that we wanted to get out, which was expiring literally in 10 minutes, had like 40 cents of extrinsic value on it. And so, we were trading it like a credit of $3 or something like that. And I knew that I could probably get 320 within the next 10 minutes. And so that's where I put my order is based on how much extrinsic value were in those shorts. Okay. So that's probably a little more than maybe you were looking for, but whoops, let's see here. When I create a portfolio with more than 3 legs and I want to see profit and loss, placing my cursor on strike point of the graph. Frank, yes, it is. It is a pain in the rear, and it is on their list to. So he's talking about when you hover over. I will show you a different trade that I am in as I'm doing this as well. Here it is. All right. Here's an actual trade that I'm in. It's for next week. It's in a stock portfolio. So the market moves. If stocks move up, I'm going to be looking, really good with my stock portfolio. If the stocks move down, or if it stagnates or whatever, I'm going to, add a significant gain on this trade. This is the trade. If you want to see exactly what it is, these are the exact fills I'm in at. These are the exact trade sizes that I have, and it's not too much dissimilar from what I've shown you. Only this was more in the money. I went for a bigger credit because I was specifically doing it to make more money to the downside against the stock portfolio. All right. So what he's talking about is when you hover over and you want to see what the total profit and loss is, sometimes you can't see the entire thing, right? But all you have to do is decrease your screen size and then you can see it. All right. So everybody sees that at 278.50, I should be making about $8,000 on this trade. All right. If I increase the size of my screen, and of course it still shows it. Why? Sometimes well, I don't know why it's not doing it now. Sometimes it cuts off and you can't see all the legs and you can't see the total trade profit. That's what Frank is talking about. I don't know why it's working on mine now, Frank. But yeah, it sometimes does happen, and it is on their list. Is there a specific reason why you're trying to get a credit on trades rather than the obvious that it's better than a debit and downside losses to know? No, Frank, I hate, I'm, most people have risk to the downside. And so this offers an opportunity where you're not adding to the risk to the downside. And in many cases, like what I just showed you on this particular trade, you actually can make quite a bit of money to the downside with very little risk to the upside. And it's a preference of mine. Markets are far more likely to crash than they are to move higher, although that hasn't been the case the last couple of weeks. Had record moves to the upside. But that's only going to happen after a crash. After the market comes down, you're not going to see these massive moves to the upside once we start getting closer to the all-time highs again. Very much muted. If you're worried about trade one, why not close it today? So David, if I absolutely couldn't, well, let me back up. No, I don't want to say that. So I'm more worried about the trade for you guys' sake, not for my sake. I hate losing. What I hate even worse is when my clients don't make money on a single trade. I mean, I hate it when we don't have 100% winners, and it's a completely unrealistic expectation on my part. It's not going to happen. It can't happen, and I know that, but I still hate it. So, to be quite frank, it's not for my sake that I'm concerned about the trade. It's for you guys' sake, because I don't know. Maybe it's your first trade that you've ever taken, and it would stink for this to, turn around and lose $150 tomorrow after we're sitting on a $170 profit today. So there's all sorts of. So that's why I say, understand your situation so that you know whether you need to or you should take action. If you feel like, you really, you want to start off with a winner, take the profit. However, you're going to leave some on the table if the market stays the same, moves down a little bit, and it'll be a significant amount. So we could look at something from a $300 swing to the downside tomorrow to a $300 swing to the upside, or more, maybe slightly more to the upside tomorrow. So, all right. So hopefully that answers your question. But like I said, in all cases, even if it's your first trade, in all cases, you have to be willing to accept the risk on that trade when you take it. Period. End of story. I say that over and over and over and over and over again because I've been in this industry a long time and I know how traders think and I know how traders act and I know what traders do. And I myself am a trader and I struggle with the same thing everyone else struggles with. I know it may not seem like it, but I do. We tend to get a little bit excited about the profit potential and kind of say, yeah, the risk is no big deal until we actually suffer the risk. And you all know exactly what I'm talking about. Right? So that's why I urge everyone again and again and again and again, you know, be willing to accept the risk because a lot of times we take trades that we think that we're willing to accept the risk, but as soon as we start to lose on it, we find out that we really weren't comfortable risking that much. Trade number 8, should you get in at a credit of less than $1 max? It's about whether you're willing to take the extra risk. Whenever you get into a trade at a smaller credit than, for example, what I'm showing here. So in the example of, and his question is regarding to this trade, should we get into this trade at a credit of 50 cents? And if you get in a credit of 50 cents, you're adding $50 to the risk. And so it's a decision that you'll have to make. And the other thing that you can do is you can move the strikes and possibly get into the same structure at a credit of $1, which will lower the risk back down to $200, basically a little less than $200. Nope, $200. And it will also bring the break-even point down because you're moving the whole strike structure down. I like to be patient and get my trades at the credit that I want them to be at. All right, so if I have, here's a question from William. If I have $200 profit now, can I take profit now and not risk an adverse move against a position? Yes, you can, William. You just have to be willing. So there's risk no matter what you do. All right. If you leave the trade on, you risk giving back your $200 and maybe losing $150. If you take your $200 profit, you gain $200, but maybe you risk leaving an additional $200 on the table. That is completely up to you. I'm never against, I'm never against adding profit to the account. But in the long run, based on how these trades work, you're usually going to come out a little bit less profitable overall. Because some of these trades, they give a small windfall every now and again, and those definitely help. So if you make $400 instead of $200, that gives you an extra $200 that in your account that, next week if you take a loss of $200, right? So you'd be break even if you take your profit now and then lose $200 next week. But then again, if you lose $200 tomorrow, here's the deal though. If you lose $200 tomorrow, there's going to be some really good opportunities to start setting up next week's trade. I can't answer that question for everybody. Is my short answer. I can only give you what the ramifications of your decisions will be, and give you a long-term perspective. Could you cover one of the profitable legs? Be very careful with that, William. If you cover one of the legs, you might leave the remaining trade at a significant debit. And if the market tanks tomorrow and that's what you just did, then you'll end up taking a loss on the trade. Be very careful with exiting a leg because there's still a lot of extrinsic value in those shorts. And so you'll be creating a significant debit in a lot of cases. Why does my PDS Trader 911 emergency 111 only go out to 422? Bernard, I don't know because I just pulled it up. So we'll take a look at it. If I understand correctly, if I want to mitigate some upside risk, I need to wait for a movement or time to pass. Yes, that is correct. I can't just put on another trade right away to mitigate upside risk. Ryan, you actually can. And this is what we did on Tuesday. All right, so I'm going to move back to, so here is a trade that was placed on Tuesday, and many traders who attended the webinar, you were on the webinar as a matter of fact, Ryan. So this is the first trade that was taken. There's a credit of $1.52. This is the second trade that was taken. It was a debit of $1.23. Gives you about a 20-25 cent credit, and that's the end result of the trade. And it mitigates the risk to the upside, and it also pushes that risk to the upside as well. Many traders were filled on both of those trades on Tuesday, one right after the other. So the answer is absolutely yes. I personally, I like to wait a little bit unless there's some reason why I absolutely don't want to take a risk to the upside that's too close, then I'll go ahead and do that. But I like waiting until I can dramatically reduce the risk, and in some cases create a risk-free scenario. And once I create a risk-free scenario, I put on another trade. I put myself at risk again because that allows stacking. And it's not something that you can do when you're taking a trade that's 2 days away as easily, but when a trade is a week and a half away, you might have several opportunities to put on several trades. Bring it risk-free, put on another one. Bring it risk-free, put on another one. It's not going to happen often where you do it more than 2 or 3 times, but it can dramatically improve things. Mark, so I think I answered that question based on what I told you, whether it's this afternoon or in the morning. So what I don't like about waiting until the morning, if you're keen on taking a profit, what I don't like about waiting for the morning of the last day is if the market opens up 5-6 points, gaps up to the upside 5-6 points, you're not going to be able to do anything. If a credit and debit spread were both done, should I exit the credit spread or the debit spread first? It really doesn't matter as long as you don't wait too long. You want to do it fairly quickly, one after another, and it doesn't matter which. And the reason is because if you take the profit of one, it's based on a combination, right? So if you take the profit of one, let's say it's $100, and you break even on the other one, all right? So you make $100. Well, if you take the profit of one, $100, and then the market moves against you for the other one, and you end up losing, whatever it is that is the risk. Let's say it's a $100 debit. At that point, you just become a market timer, and I'm never in favor of becoming a market timer. That's just my 2 cents worth. How do you prepare or handle volatility dropping out of the longs with these 1-5 2-week trades? What I do is I try and push the risk as far to the upside as possible by adding to the trade. With 1.5 weeks, week and a half left on the trade, there's time for the market to move and allow you to, do something with the risk. That's my main go-to. John, there's really no, okay. I will send an exit using the smart order, and you can either choose to use it or not choose to use it. And when I'm doing it, I'll try and do a quick video with it and post that on the site as well. I got a lot of the same questions with regard to exiting the trade. If the trades in the overnight shorts crash down, should we sell to take some profit and resell as the market comes back? If it does that, yeah, you absolutely can, Lewis. If the market tanks, you're probably you got to be careful though, because if you exit one of the shorts at 50 cents, you've just dropped your credit by 50 cents, which means your total credit now is only 90 cents, which is fine, but you just have to be aware of that, because if you do it too soon, you'll create a debit on the trade. Let's see. Again, I'm not in favor of trying to become a market timer. I can't. If you can pick direction of the market, great, more power to you. I can't. There are some certain setups that I like, certain patterns that I like, but if I'm just willy-nillying it and saying, hey, wow, the market opened down big, I think I'm going to go ahead and take, exit a profit because the market's going to come roaring back before the close, and then I'll get an extra profit. I can't do that. Um, and I haven't met many people who can. I'm not in favor of becoming a market timer, but you know your skills better than I do. Thanks, Tim. I appreciate that. And I combine the graphs for different legs to see break-even profit or loss points. Yeah, if you go back through, so I strongly, and I'll repeat it again, suggest that you go through all of the videos in sequential order as soon as possible. I have tomorrow's trade hedged, but I've been spanked so many times on Friday that I would normally agree with the guy who wants to take the smaller bird in the hand. Yep, that's it. That's why I said there's nothing, it's not necessarily a wrong answer. It's just a matter of, are you willing to accept the ramifications, the consequences of your decision, knowing what they are. That's the important thing. On the second mitigating trade, what relationship is the strike swings? For some reason, it cut off your question. Why in the world would it do that? There we go. Relationship to the strike swings, the high side up and the low side down. Frank, I'm not quite understanding your question. How about the calendar at a lot less debit, say 290? 290 is a big debit. So a calendar is available. You're going to pay about $1 and you'll make about $1 and you'll lose maybe 50 cents if the market stays the same. So let me go back here and we can take a look at a debit real quick. Well, there's way more questions than I was expecting. Hang on one second for me. All right. So here is, for example, a 284 debit. This is a 284 debit. That's going to create a profit peak at 284, so it will offset some of the loss if you were to do this. So obviously you can do that for a debit. But if the market stays right here, you're going to gain 60 cents, and you're probably going to lose. So you very well may break even on this trade if you were to do a debit of $1 if the market stays where it is right now. If it doesn't, if the market moves up, you're probably looking to 284. You're probably looking at about a 350 spread. So you'll gain maybe about $250 on this trade at 284. So it's definitely something that you can do right now that will mitigate some of the loss, maybe even all of the loss at 284, maybe, and it'll cost you a debit. So it's definitely doable. If the market crashes, your credit is now on the entire trade is only 40 cents. Right? If the market moves up, I'll give you. So if we take a look at where are we trading right now? We're trading Man, we're back above 279 again. Whoops, going the wrong way. So let's take a look at the 279s right now. So right now the 279s are only going for $1.42. However, if the market moves up, you're going to the profit peak is at wherever your strikes are on a calendar spread. And you have to realize that, right? But there's 245 of extrinsic value in the 279, and the long is only trading at 391. So what that means is that tomorrow at 279, the long is not going to be trading at 392. It's going to be trading at maybe 330. So we're looking at about $200 to $230 profit right at the strike. So if you wanted to do a 284, you could do that. Let's take a look at the graph real quick. And clearly, I'm not going to get to the second part which is fine. At 284, this is projected to be losing. It's going to be losing more than a couple of bucks. It's probably going to be closer to $100. If the market moves up to 284, it's probably going to be at least $100 loss, maybe a little bit more. And at 284, you're going to be looking at a profit of maybe $230 on a calendar spread, 284 calendar spread. So it absolutely is viable. So you were looking at the high end of a calendar. The problem is that if you go too high, it's going to be so far away, it's not going to do any good for the higher probability. All right. Can you please put that in a risk graph? I sure can. If you will bear with me 1 second, I will get that loaded up for you guys to see exactly what I'm talking about. 277 is the long, and then a calendar spread of 284. And so we're going to look for a total credit of 40 cents is basically what you can do right now on this calendar spread. So I'm going to finagle it just a bit. Oops, I did a sell and I meant to do a buy on that. So 1 second. Sorry guys, I'm just going through the process of getting this loaded up here and at the right prices. This is a credit of 38 cents, so close enough. Which reminds me, I'm so glad I did this because I almost forgot about it. When I do a debit of a calendar spread, I'm not creating any profit. I'm actually adding to the risk to the upside. All right, now, granted, at 284, I'm looking at a total profit of 243, but I'm going to drop these. I'm going to drop the volatility down a bit, and so at 284, maybe $130 profit at 284. But then I add $100 to my overall maximum risk. And so you do have to be aware of that. If the market just screams to the upside for whatever reason, goes to 290, you're going to be suffering a $250 loss on the trade. You can do another calendar spread further up, which is suggested by one of the members here. But again, you're adding risk, and the probability of the market going to 290 in 1 day, there's the point at which you do too much and you're playing to the complete improbabilities. And so you do have to be careful about that. Okay. That was quite, yes, so that, Bernard, exactly right. You dramatically extend here. Let's do this. Let's separate these trades out so you can see them individually. Do the second group. All right. So you can see the Group 1 at 284 is saying losing $100. It's probably going to be a little more than $100. And then Group 2 is projected to make about $230. That's probably pretty close. So the yellow line is our buck 40 trade, and then the purple line is the calendar spread. All right. Well, sorry I did not get to the second part. You have 5 minutes left if you want to put on a trade. Where are we sitting at? If you wanted to do something to potentially hedge tomorrow, whoops, that's not it. Where are we at? And there we are. And the market is, still trading at about the same towards the close of the day. All right. Looks like I got all of the questions. If we may have a call tomorrow, we may not. We'll see. I'm not going to plan one, but if something happens tomorrow, then I will post one in the morning, and we'll do it at 1 o'clock, 1 o'clock Eastern. That will give everybody 2 hours before the market closes by the time we end. All right. All right, everyone. Have a wonderful day.